Dear colleagues, thank you for accepting our invitation. Today the Central Bank Board at its meeting decided to reduce the refinancing rate by a quarter of a percentage point, setting it at 7.75. Mr. Galstyan will present to you the press release. Thank you. At its meeting today, the Board of Central Bank of Armenia decided to decrease the key policy rate, setting it at 7.75%. At its session of July 30, the Central Bank decided to reduce the refinancing rate. The board agrees that the lower refinancing rate is necessary to continue to meet its price stability objective of ensuring an inflation rate of 4% over the medium term. Annual CPI inflation has continued to remain at low levels, well below the target. In June it was 0.8%. The 12-month core inflation remained unchanged, standing at 0% in June. In Q2 of 24, risks of slowing economic growth globally and the key trading partners continue to persist. The global inflation continues to decline, however, sticky prices continue to remain relatively elevated in key trading partner economies. At the same time, overheated labor market conditions continue to contribute to sustained high demand conditions in key trading partner economies. Persistent geopolitical uncertainties, as well as growing tensions in international trade relations, continue to create risks for future growth in global commodity prices and potential disruptions in global supply chains. In this context, it is likely that key trading partner central banks, in particular the U.S. Federal Reserve Bank, would maintain tight monetary conditions for longer. Consequently, weak deflationary effects from the external sector on the Armenian economy still persist. Economic activity in Armenia remained robust in the second quarter of 24, continuing to be largely driven by meaningful growth in the construction, trade and industry sectors. The latter continues to be impacted by certain short-term factors, posing significant uncertainty with respect to the sustainability of economic growth and its long-term outlook, as well as the strength of domestic demand and consumption. External demand for domestic services continues to slow relative to 23. At the same time, risk for demand pressure stemming from fiscal policy continue to persist. Furthermore, labor market conditions continue to cool, reflecting in the cooling pace of wage growth. Non-traded sticky price inflation and inflation expectations continue to decline. In order to manage possible risks stemming from conditions of high uncertainty, the board considers multiple scenarios during its deliberations. On the one hand, the board discussed scenarios where possible underlying developments will require a higher path for the policy rate relative to current market expectations with respect to partner countries. This includes scenarios related to persistently tighter monetary conditions in key trading partners, as well as uncertainty related to counter-risk premium and neutral interest rates from both global and fiscal policy-related considerations. On the other hand, the board discussed scenarios where potential economic developments, including the risk of weaker demand conditions emerging, given certain structural features of economic growth and cooling labor market conditions, would cause inflation to persistently remain at a low level for longer. This would imply a more rapid and aggressive downward path for the policy rate than what is currently priced in markets in order to sustainably bring inflation back to target in the medium-term horizon. Seeking to minimize the losses that could stem from these and other scenarios materializing, and balancing the aforementioned risks in both directions, The board finds it appropriate to continue to gradually ease the policy stance. The board resolutely affirms its commitment to adopting the appropriate policy actions and strategy to ensure the price stability objective of 4% inflation in the medium term. The floor is open for questions. Sputnik. Thank you. The question is your analysis of external demand. The reason I'm asking is that within the last several months or a year, the next non-exportable sticky price inflation insofar has slowed down a little and then remained in the neighborhood of 3%. Concurrently with that, you also mentioned in Q1 CPI that the external demand is gradually decreasing and incoming tourists per capita expenses go down. How could one explain, considering your vision of the external demand, nevertheless the services that feed on external demand, their inflation doesn't go below 3%? Thank you. I do not know whether we have a slide on that or not. Our observations. Hold on a second. We look at the services now on this chart. The services has gone down. The trend that we had observed, the non-tradable sticky prices being on adequately high level persistently, this trend has broken and there is a trend of decrease currently observable. You're quite right. This is determined mostly by the easing, weakening of external demand, which is explained by several factors. One is that incoming tourism numbers are lower over last year, and our statistics committee has recently published indicators which indicate that the per tourist expenditure has also decreased. The second contributor is that we had labor migrants, international visitors incoming. Some of them, according to our statistics, have already left Armenia, and this is not only with respect to highly qualified labor, but also low blue-collar workers. We looked at the numbers yesterday. Out of the arriving Indian citizens, about 1/4 is no longer in Armenia, according to official statistics, which once again affirms the weakening of external demand. Arrival in which period? They started coming beginning of last year. As of now, it peaked at 17,000 Indian citizens. The last observation is 11,000 currently in Armenia. The last data was published either end of May or June. Do you estimate as a result that the services shall continue to gradually register declining prices? The slowing of inflation rates is what we see. Hard to say at this point whether the prices will go down, but the growth rate will slow down, which is what we estimated. Civilly net. Thank you, Mr. Galstyan. I would like to ask a question on important exports. A few days ago, an analysis was published which stated that if we dismiss the re-export of gold, the exports have declined by 16.5% and imports by 10.5%. What can you comment on this? If we compare it over last year's indicators, does Armenia erode its export potential, or is this current situation? If we compare with the crisis of 2021, there's still growth visible. We're inclined towards the second option scenario because the numbers you mentioned with some discrepancies indicate the fall trend in exports and imports, but we know that last year was specific in those terms. The volume of re-export in our economic overall activity was quite significant. If we compare it with the regular normal times at this level, at this point, our export-import levels are higher than in preceding years. All other things equal. Let's imagine the Ukrainian crisis is not there. These re-export opportunities do not present themselves. May we safely claim that we will get back to January of 22 indicators, or the potential has increased so far that there will be no great falls? I believe we would not revert to the levels that we had, let's say, in 2019 or 2020. We will be on a higher notch. As to where, hard to say, because that is asking for a micro analysis to understand which sectors of the economy within the recent years have become how much more productive, and whether they could ramp up not only the volumes of their production but also enter new markets. Because one may produce, but as to which market you can destine it for and whether your products are unique or could be replaced by similar products in other countries remains to the area of dedicated analysis. One more question about the budgetary indicators. The shortfall in the budget implementation, if I'm not mistaken, 116 billion drams less was collected, taxes and other revenues. How could this impact public expenditures and the economy overall? What's your estimate about the economic growth considering these factors? Have you reviewed them or not? From the fiscal policy perspective, there could be two alternatives, three alternatives, several alternatives, let's put it this way. Shortfall in revenue is because the economic indicators were weaker than planned. The question is whether we planned it all properly beginning of the year and considered some deviations, or is it an issue boiling down to real economy? I think it's mostly planning deficiencies. As for more or less expenditures as per government resolutions, I think that there will be certain adjustment, not big of sequestering, or I think there will be no sequestering in the agenda, but there will be certain adjustments. There's room for it because we have room to increase debt and we have room to work with a slightly higher budget deficit. I think the government will find the reasonable ratio, which will contribute not only to avoiding the scenarios you mentioned, but also will allow not to impact the economic activity. So your estimates of economic growth remain the same? We do not estimate as of this year economic growth. If you look at the market estimates, it's about the same 6% of expected economic growth. Sputnik. Thank you. In the previous estimate you mentioned that although the economic growth is high, it remains highly concentrated, which leads to certain risks, including the limited sectors that contribute to growth. In one of the scenarios, it could result in long-term decreased demand and long-term background of weak inflationary pressures. The over-centralization that we have observed end of last year and early this year, thankfully, has been overcome to some extent, and the graph shows you that the distribution of economic growth by sectors or drivers has become more diversified. The agriculture, construction, and there is a certain problem with processing industry. If we remove the over-centralized economy, we've done this analysis, and we think that the processing industry has opportunities for rehabilitation. So the numbers of 10 are quite stable. January to June we have 10.4% economic activity indicator, which is broken down by sectors in here. This over-centralization issue is already addressed because those transactions are no longer playing such a dominant role factor. Thank you. About 2 years ago, the cash circulation restriction was introduced. Trade related, over 300,000 had to be cashless. What are the results that you may report on this? And a follow-up question related. Our officials often state big amounts of cash kept not in the bank but at home, including yourself. The question is, does the state have room to do something here, or is anything initiated, considering the European experience as well, where major cash outside of the banking system is frowned upon, to put it mildly? Our legislative initiative pertained to payments in cash. Cash as a payment means in excess of 300,000 drams. As for cash as a saving vehicle, there are various motivators for it. One is diversifying the portfolio. For example, if you look at the ratio between cash and other types of assets, I believe it's reasonable to some extent to have some cash in portfolio management perspective. It gives you some diversification of risks. But if the predominant majority of your savings are in cash, that's not what I just mentioned. It pertains to something else. In this respect, I do not know whether there may be legislative initiatives to address this. Remains to be seen. I cannot refer to any international experience about this. Quite naturally, if you have assets that amount to 20-30% of your assets, that's reasonable. But if it exceeds 70% of your savings, or all of your savings are in cash, then the portfolio theory would not apply with the one that I referred to. Corruption risk, transparency of turnover, don't you see risks here? Frankly speaking, as the governor of the central bank, I find it difficult to comment. There are agencies that are reserved the right to comment on that. Mr. Galstyan, I was referring to the reduction by 0.25% to the refinancing rate. For the update time, it's 0.25% notch each. What's the rationale of this caution in the conditions of extremely low inflation? What's the rationale? We get the impression that this is a mathematical exercise with not enough consideration given to the real economic situation when businesses have serious issues of accessing financing, especially small businesses. Let's say if we compare the broadband in our economy with the European countries, it's less by several factors of time. What's the reason of this caution? That's a good question in reality, and it brings a brings us back to the profound understanding of our framework. We look at the multitude of scenarios, which include scenarios containing acceleration or reversion risks of inflation. These are geopolitical risks, fiscal policy, expansionary risks. The US Fed has kept the rate, may keep the rate high for a lengthy period, which if we are below our neutral rate, substantially boosting the economy, we create other risks. If in America the rate is 5.5 and there is a country risk premium, how much more can we reduce our rate without risking extensive outflow or flight of capital out of the country in given geopolitical situation? We look and see that the T-bills of other developing countries and our Eurobonds have a certain spread, which expresses the risk premium that the investors demonstrate exists by their behavior. Why do we proceed by small steps, observing that there is a decline trend in the economy? Because all those risks are still present, which is why as a result of our balanced policy, we persistently reduce the rate, but we deal with marginal values. If at this condition the central bank is more adventurous and sharply reduces the rate, it will lead to consequences to be dealt with, and that would erode the trust towards the central bank. People will ask, if you were going to reduce it so abruptly and the inflation would have soared, why did you go for it? So by balancing these B-type issues, potential decline in the economy, balancing it off with certain potential opportunities that may result in pushing the inflation upwards, we decided to be very cautious, proceed by stable, low rates in addressing these issues. Civilynet continues the question. Mr. Galstyan, you mentioned, considering that the Fed is 5.5 and we continue to reduce, there is a risk premium. Could you expand on that, about the capital flight? In simpler terms, if those conditions, if the Armenian refinancing rate were to be lower than that of the US, the assets and the investments would preferably be moved to US or other countries. Let's consider hypothetically that you're Goldman Sachs. Let's say hypothetically you have 100 units to invest, and there is a jurisdiction, the US of A, the dollar, you can invest in dollars within the percentage you mentioned, and there's the Republic of Armenia where you can invest in drams at 7.75%. So you start to ponder and decide whether the risk is proportionate or not. If you decide that 7.75% doesn't offset the risks which you assume by investing here, at that point in time you move your capital and it gravitates, which is called flight to quality or flight to safety. As a result, those processes may be accompanied by drastic devaluation of national currency, you name it. Sputnik. From the previous announcement, you mentioned that the gap between developed countries bonds and our euro bonds has a risk of widening under certain scenario. Do you consider this scenario as a non-basic one? We do not have a basic scenario, but the weight attached to it, is not it increasing in your projections? Are you looking at conditions which may result in these risks materializing? and this gap widening. We look at the multitude, at least we do our best to look at the multitude of possible risks, whether this way or that way. Hold on a second, this is the chart. If you look at the yellow line on the right, the scenarios pertaining to us keeping the rate higher, which I indicated in answering Arshalis's question. The red dotted line is market expectations. The behavior rate should be kept by the central bank higher than the market expectations. In the absence of such risks, if we're in a domain when there is only B type of scenario risks, we should follow the logic of the blue line, drastically reduce the rate, that is. But since we deliberate and understand that there is B as well as A, which is why we say in balancing them off, we arrive more or less, give or take, at the rate that the market expects. At this point, the market expects that we persistently and slowly will ease the rate. There are market players, of course, which expect that we should already quit lowering the... in our most recent survey, about half of the market players expected that 8 was the level that the central bank had to keep the rate at. The other half believed that it still should go down persistently. No mic is used in asking the question. Do you want the names of the participants? It's the respondents in the survey were banks and participants in the financial market. We keep the finger on the pulse of the market, so to say. Sputnik. About the Fed rate, does it mean that we should follow closer the demand for services dynamics in the United States? Because in the several first months of the year it remains higher than expected, and if it stabilizes, the Fed may adjust its policies. They have a special sticky price index that the Atlanta Fed is calculating. We track not only that but many other things in order to understand what may be the behavior of our American colleagues. If we look at the futures market, there is a great likelihood that in September they will take a step to lower it. You may remember early this year when we were talking, the market players had the expectations that the Fed will reduce the rate 6 times over the course of this year. If I remember it correctly, I said I do not have trust in that scenario, although the market did. Life demonstrated that the Fed to this point has not reduced the rate. The market is expecting that in September most probably they will reduce it for the first time ever. The main uncertainties, apart from the economic contributors, also contain the political component. Reducing the rate on the eve of elections may be interpreted several ways. If we wait until the end of elections and reduce it, it will be interpreted otherwise. So the central bank is not best positioned in this respect. It's not enviable. Bank News AM, Astrid Pilipasyan. The ratio of sovereign debt and GDP has a ceiling, a cap by law. By the end of the year, it should not exceed 60% of preceding year's GDP. The Eurasian Economic Union has a lower cap. Do we abide thereby? Because according to Q1 data this year, Armenia has the highest growth of sovereign debt among Eurasian Economic Union members. I would prefer not to answer that question because it's beyond the remit. of the central bank, way beyond. To the best of my knowledge, it's not law, it's a fiscal rule that you're referring to most probably. The fiscal rules allow for exceptional circumstances under which you could go beyond the cap. Are we talking about 60 or lower at this point? Our law, what's the de facto? We're below 50% now. So if our colleagues in the government decide to increase it, or in under-collected revenues keep the expenditures the same, they may do it by borrowing. We will not get to 60, I believe. The fiscal rules require something else, but I'll not comment on that. If you increase your debt above a critical cap, your current expenditures have to follow certain rules. There are issues with capital expenditures. There are issues, but I don't believe it's acute to the extent that we're nearing the 60% threshold. If it's within the CBA remit to contain the sovereign debt, we're not doing debt management. The debt management office is in the Ministry of Finance. That's who is responsible for it. What we do is mechanical action. If the partners in the government have a need to service external debt, we take their drums, convert, give them back foreign currency, and they service the debt. We're just the financial agent of the government. We're not policy maker, or we're not implementing any policy in this. What about local and foreign currency risks? Are they observed? What do you have in mind in the sovereign debt? I don't see anything risky at this point. Don't believe. The debt in drums has significantly increased. The dollar drum or forex drum proportions have significantly shifted. For the first time ever, if I remember it correctly, the drum exceeds forex debt. Civilian debt in an important economy for Armenia. Russia openly speaks about overheating. The expenditures are quite high, and there is a serious issue with the workforce. How may this impact, or what impulses may it transfer to the Armenian economy, considering our economic and humanitarian and migration links therewith? What impulse or impact this may have on Armenia? You may have seen that our last decision, the last decision of the Russian Central Bank, increased by 2% their rate. The governor of the Central Bank of Russia, in a press conference, referred to the Phillips line, the overheating in the labor market, that is, and the fiscal signals or expenditures significantly increasing. What may the monetary policy do if the country is in such a fiscal spot where there is an imperative to carry out the expenses? They have that imperative, that is. If we are open and frank about this, the monetary policy should proactively increase substantially the rate in order to constrain the demand-driven impact on inflation. But whether from the perspective of political economy it is realistically possible to do this in the country in question, in the circumstances in question, as to what could be the impact on the economy in this event, it may be quite a complicated impact. If you keep spending without a parallel increase in productivity, this does not translate into product creation, but translates into increased prices, which will make the central bank to respond, increasing the rate, which implies increased lending interest, reduction in investments. As to the possible impact on the Armenian economy, when we recently were discussing it, and we looked up this yesterday, our outgoing migrants, there are two hypotheses. The number of our outgoing migrants those who travel to Russia has declined significantly. The real wages difference that we had with Russia has narrowed. They receive it there in Russian rubles. If you convert it to Armenian drams, it's more or less the same wages here, slightly more than what they could get here in construction or in any other sector. In this respect, we could say that we are protected. Not so many people leave and they instead find jobs here. But if in the Russian economy there is some negative process underway, naturally it does have an impact equally negative on the Armenian market, weakening of external demand and other transmission mechanisms. About the reduction in the difference of wages, you mentioned it as a risk, but maybe we could expect certain inflows into our economy and increased product. Maybe we'll even see. We're looking at it in these scenarios. I don't know how likely is this at this point. You're referring to a new wave of incoming, returning labor migrants, but these are not economically motivated. Their motivations are first and foremost other. Have you encountered instruments that at least approximately could estimate behavioral, how would our labor migrants behave, or is there no reliable tool to estimate it? At this point, we were talking with Hike today. Most probably next year, in the main migration season, we will conduct a survey among our compatriots, asking about their motives to understand what's the rationale of their decision to leave and what's the push and pull factors. And secondly, we would like to understand what's the modality of remittances. You know, it's getting more complicated to remit. So did our citizens change their behavior? We have arrived at a certain point at drum remittances, but under the sanction regime, people still may prefer cash in the bags. So the transaction expenses may have a significant role in their decision making. The transaction expenses will not affect the global decision, but whether it should be cashless or cash transactions, the transaction cost will have a significant impact on that. Among the commercial banks in Armenia, we do not have a global player. HSBC has left because of its global policies. It didn't only leave our country, but many other countries, and the Armenia transaction is just emerging. There are these opinions that for major external players, for a Wall Street player, it's hard to perceive the Armenian system because it comprises local banks. In this respect, in systemic terms, what change will the Armenia deal bring to the systems? The banking system becomes more localized in the world. The players that in the wake of the collapse of the Soviet Union looked this way, Eastern Europe, FSU, as room for expansion. In my perception, they no longer thinking along those lines. Everyone is going contracting towards their own local jurisdiction. HSBC in this most recent strategy, which is called Pivot to Asia. The same is happening with Citi, which is a major player. What's the rationale? It's the major risks that have accumulated in this region, not only geopolitical but also sanction related, because operating in this region results in lots of compliance requirements and abiding by the rules, which are costly. It is in this perspective that the global players make up their minds. You know that if FACTA is violated, the fines and penalties are substantial. Not encountering those risks and 100% managing those risks is not easy, it's very difficult. So the global players prefer at this stage, when there is this great uncertainty, to refrain from entering new markets, which, if you ask me, is mostly determined by overall accumulated risks magnitude here and in the region. What about BRICS countries? Shouldn't they look at new banking opportunities and systems? I understand. Frankly speaking, I'm not aware of such plans. It would be hard at this point to say something whether China, Russia, Brazil and other countries may join, on South Africa will be able to create something like that. As far as I have heard, their objective, declared at least, is to create a alternative to the current financial world order. Early in the year you mentioned that there is a high level of savings in the private sector, and that was a possible room to increase investment appetite. Did you notice any investments in the economy on the expense of those savings? Legal persons' deposits have not increased significantly since early year, but they're still more than a year or two before. Let me look it up to answer meaningfully. Time deposits of residents, legal persons. For example, end of June this year, if we compare time deposits with the previous year, there's a 17.4% increase, both in drum and in forex. 15.8 demand deposits. The forex is more than the drum. I don't think that the trends have shifted significantly. Whatever we've been observing in the previous years still holds true, and we'll continue to observe that this year. As for 2025, we'll try to understand what would transpire, but at this point in time I don't expect anything substantial. The question is whether the businesses are ready to invest in real economy those accumulated savings. Hard to say. I do not know of their intentions. The current uncertainties impede with that to some extent, but as to which business projects, hard to say. We're dealing with two possible scenarios or phenomena. We consider both. If you've been following, naturally you already know. One is, as Mr. Galstyan mentioned, there is certain uncertainties among business agents, economic agents, which is why they keep deposits intact, deferring investment decisions. And the second component We need to look within the last 2 years. Our economic activity was pretty high, and the turnover of companies and the product they created was quite big. So we also deal with their operational servicing capacity, which needs to be increased, which is reflected in demand deposits component increasing. Both components exist, and from our policy perspective, that which we view as an uncertainty scenario is exactly what Mr. Galstyan mentioned. That is, after easing these risks, will they be steered onto investments? That will be visible in economic activity development. At the same time, the survey among the banks demonstrated a progressive increase. Was this driven by legal persons, or was it natural persons' consumer loans? Does this mean their investment appetite is, after all, increasing among natural persons? The respondents, if what you're referring to is the demand was mostly by natural persons. We've talked at various opportunities. This is mortgage and consumer loans, which the demand for still continues. As for businesses, both the survey respondents and de facto indicators fail to demonstrate substantial activization, which indicates the scenario we refer to, deferred investment decisions. This behavior is quite visible. Public radio. The construction remains to be one of the drivers of the economy, but the developers already start talking about the income tax return law restrictions by the end of this year will result in certain developers going bankrupt. Do you see a concern in the banking sector about major developers becoming insolvent and pulling the banks behind them? Do you see major financial risks in your scenarios? Thank you for a good question, and an important one for that. About this, the real estate prices, that is, and the policy of returning the income tax to offset mortgages. In the economic theory, there is this premise: when you implement industrial policy, that is sectorally targeted economic policy, it should be exclusively aiming at removing an imperfection in the market and should only be temporary. That's where we should depart from. When we leave the territory of the income tax return, which was a major impulse for individuals and businesses, quite naturally we had supplied this wide pipeline to the economy. When it narrows, of course, there should be consequences. Let me tell you what we have done in order for the financial system, which was the lender both for construction companies as well as private mortgages. So what did we do to mitigate? We had agreed with the banks, and as a result of central bank regulation, the banks have increased their counter-cyclical buffer by 150 percentage points. They did not distribute it between the shareholders, but increased the capital buffer or provisioning in order for the eventualities that you just indicated, for the banks to have enough resilience to withstand those developments. And the next item is the special accounts. We looked at whether they have means on the special accounts to restrain the potential risks. Most of them had these special accounts, some did not. but that was because of imperfection in the legal regulation. If a developer were essentially able to get consent of a person's signature, it could then access the funds on the special accounts. We have done several exercises in this respect, so I believe there are no substantial risks looming over the financial system currently. In the previous statement there was this interesting analysis. This is my favorite press conference because you keep referring to the previous report. IT productivity and midterm output. It was quite a profound analysis of the sector. So, did the central bank have an opportunity to dig deeper into this analysis? Is there any risk in reduced output in the ICT on the expense of partial departure of Russian companies or individual entrepreneurs? Do those sectors in the ICT develop that are not yet so proliferant, AI and big data, that is? It's hard to get to that micro level, but the question is on the macro level, whether the ICT will maintain its output. Unfortunately, neither micro nor macro level do we get so deep into individual sectors. But anecdotally, we feel that ICT is weakening even in America. The companies that are involved in ICT, there are companies that will not be affected because they produce integrated circuits, the demand for which is infinite, but there are still companies that feel the impact in America of the certain weakening of this sector because of the price of money getting higher. As to the degree to which these companies are related to Armenian counterparts, we have a concern that this may have a chain reaction on our output. That's one channel. For example, there is an American company that has an Armenian spin-off with 50 employees, so if they get less commission, there will be less the share of Armenian subsidiary. And the second direction is people who move to Armenia, high-class engineers, tech-savvy people. What do they see as their future? Do they link their future with Armenia, or was Armenia just a country convenient initially, language-wise, and considering other factors, and now there are other jurisdictions that are more attractive? Berlin Economics have done that survey. If I'm not mistaken, there were several questions. The reason we were interested in it is because there was always a referral to the strong foreign exchange rate, and IT was suffering. We looked at the respondents of several surveys. They do reflect on the exchange rate, but it ranks lower than health or education or transportation considerations. There are issues that we need to reflect on as a result. The government in the past as well as now has ambitious projects to address this. The design of those interventions has to be such as to answer the component of your question as to what the future IT holds for this country. We may support the direction of IT which may not exist 3 years down the road. Whether we should do it, whether we shouldn't do it, and how, if at all, hard to say because I'm not an expert in that. In June there was this interesting phenomenon observed. Consumer loans at 29.5% increase. The experts were concerned about this. claiming that household loans increase faster than their income. If this trend persists in the future, may this pose a risk for the banking system? Because there could be an increase of NPLs. In terms of the banking system, that's exactly their business, to manage those risks. If they fail to predict their clients' cash flows, whether they would suffice or not to repay the loans, that's exactly what banking business boils down to. I think our banks are delivering on their mission adequately. As for those June indicators, we're looking at these issues from the angle of financial stability, not exactly monetary policy, but it's on our radar whether the real incomes. We see that there's quite a lot of savings that the households hold, whether they are the same groups that borrow. We look at those micro indicators as well, but just one indicator of a hand-picked month is not representative, may not be representative enough. We should look to see whether there's a trend. If the trend persists in mid-term, if we have a lot of increase in borrowing, that will naturally impact our policy. Not only from the financial stability perspective, we will see its reflection in the monetary policy as well. If there were to be a boom of internal domestic demand without being supported by increase in productivity, we will follow suit. We should look at this on the time perspective. Within the previous 2-3 years, there was a high growth. Concurrently with that, there was the consumer lending and consumption was somewhat behind. So like Mr. Galstyan said, the savings are now a basis for the demand and consumer loans to some extent to get back on track. I'm looking at the numbers. Increase of natural persons loan in 2018 was 30%, in 2019 31.8%, then 11%, then 4%, in 22 it was 15%, in 23 was about 20%, now it's hovering around 10%. By reducing their financing rate, you're moving to a policy of relatively cheap money. Apart from restraining inflation, has the central bank looked at whether this will be beneficial for certain sectors of the economy? I cannot look at it from the sectoral perspective. The instrument of the central bank is a blunt tool. It's not so precision targeting, laser sharp. It just affects the entire economy, short-term price of money. As to how the transmission mechanism will transfer it to various sectors of the economy and how they will respond, it will be hard for me to say at this point. But what do we see as of now, which is obvious, is the affordability of the short-term sovereign debt return significantly reduced. We get from 10.75 to 7.75, 3% down, and there is a 2% reduction in the short-term sovereign debt. So the government can borrow cheaper, which for our colleagues is good news in the government. The fiscal space issues that we were talking about, well, they get it eased to some extent. As for the loans, there'll be a time lag in the impact on the loans, hard to estimate at this point. The overall environment is quite uncertain around us. So it's not purely market instruments that we reduce. There is cheaper money available for banks. They take it more affordably and give to their clients. Unfortunately, there are many other factors impacted those decisions that impact the risks significantly. We see the activity of consumer loans. When we're talking about the cautious approach of business behavior, the trade should also have been galvanized following the consumption. Electronics, interior design, those sectors are not so credit intensive as manufacturing would have been. Therefore, the business doesn't feel to attract additional loan funding, which would have been the case if it were talking about production. If I understand it right, that's why there is no adequate demand on the side of businesses to expand. Well, that trend is observed essentially, but we need to understand, when Armenia was asking about the real estate market withdrawal from those projects, we need to understand that those projects that existed in Yerevan, the return of the income tax, it triggered the behavior where people took out mortgages, paid the interest, the government paid the interest, they only paid back the principal. That was significantly reducing the risk of the lending. The banks wanted to lend because the risks were significantly contained. So if you have free funds, some of it you invest in high liquidity assets, and the other you eye already investment possibilities. The change was the links mortgage followed by consumer loans. If you bought a house on mortgage, you have to furnish, you have to repair, do the interior. As for the businesses, since we had great positive impulses in the economy a couple of years, the businesses have accumulated significant funds and they do not need additional loans. There are businesses that take advantage of concessional loan products. Some other businesses, considering the uncertainty, do not want to invest, and there are businesses who take out loans. If you look at the overall logic of borrowing, there is a certain increase of business loans in Armenia observable. They do exist, but is this comparable with the mortgage lending volumes where there is programmatic interventions? Logically, of course not. Can we assume that the banks have more interest in giving out mortgages and consumer loans? Mortgages are about 100% certain deal, and the consumer loans have higher interest. So can we assume that in the mortgage segment, given the absence of competition, there is a premium that the banks receive because there is no signal to compete? You mean the demand is so high that there is enough room for all players and they shouldn't compete? If they know that the government will pay the interest this way or other, but in that case you have to be more aggressive in your interest rates, which boils down to competition. The demand has been so high over the recent years that the players each found a segment of the pie themselves in mortgages. If it's not significant for the consumer, what would be the rate? The bank is not interested to reduce it. If you could make the client your long-term client, building a relationship, of course you would prefer to offer a lower interest than the competitors, which is why the mortgage, when we increased from 4.25 by 6.5%, the mortgages didn't go up by 6%, but by 2%. We expect that end of year, early next year, when we will reflect on the floating interest anchored to the price of money, there will be some reductions observable. The developers tell us that their main buyers are not the ones taking advantage of mortgages. They're buying a second and the third house, mostly IT guys, They receive high wages and they do not take advantage of that interest income tax return. Maybe our analysis demonstrates that the second house buyers account for about 14% and another 5% are buying third houses. Green energy lending. Do we have any data about the trends in Armenia? And since the EU has qualified nuclear as green, this new nuclear reactor, what are the possible loans that could be attracted? Frankly speaking, I'm not aware of that subject. It will be hard for me to say anything. What about green energy? We have developed our own taxonomy. Together with the financial system, we will work under it because that's an imperative. It's a very important dimension today in order for us to be able to move the financial system on the green tracks. The risks that may emerge among the clients who are in the gray zone, not green, it could be impairing the climate stability, and the banks realize that very well, so jointly with them we will do our best to put the emphasis on green clients on the expense of funds attracted from the outside. There are funds available and they seem to be coming, and our banks are actively participating in attracting those funds, but maybe it could be their own means. By the taxonomy, I mean the definitions, formulations, as how this will be positioned in the risk-weighted assets. Hard to say at this point. You mentioned that the private sector savings remain high, individuals that is. In the wake of the COVID, this seems to be a background trend. We keep saying that the consumers have high accumulation of savings. How come they didn't expire within these 3 years? And the wages and the incomes quite naturally have increased. In 22-23, the overall economy, if I'm not mistaken, has increased by 16.7. 2 consecutive years of such growth get distributed in the rest of the economy, and some people save. Well, it's not increasing that much. It looks as though, at least at this point in time. And the logistics, within the recent months, it's been mentioned as a risk from the external sector. Have you tried to quantify it? What's its share in the overall inflation? Maybe those indices may lead to certain conclusions. If we look at a simple calculation, it's nothing difficult we can do and share it with you, but the problem is elsewhere. If in the Middle East the situation escalates, it reflects not only on freight movement, because the Houthis are in the Red Sea, but it affects the oil prices as well. The tension affects the oil market. The oil then gets converted to gasoline. The gasoline then impacts the consumer goods. The freight prices were reflected in one of those recent slides. You remember during COVID the freight was increased. As of this point, we're at 50% mark compared to COVID. Container freight is half of the X, and the X is the COVID level. If I'm not mistaken, in 21, in one of our monetary analysis we indicated, and that analysis was not only ours, it was contributed to by IMF and some others. Whenever the freight increased and maintains a high level for 3-4 months midterm, between 9 and 18 months it takes for this to transfer into de facto inflation. There is a big time lag because there are contracts that are not yet expired, and then there is negotiating positions of the parties. When we're dealing with conventionally 1 month of change, it almost does not get translated into inflationary environment. It has to stay there for much longer, and after a certain time lag it will percolate to the consumers. About external sector signals, the world food commodities are past the bottom, and may we now assume that the external sector, inflationary sectors, are not weakly inflationary but may be neutral, or do they still remain weak inflationary signals? They seem to be stable. If we're talking about FAO, that's the language we could use. The language doesn't essentially matter because we do not have substantial risks originating from there. That's what we want to communicate. For example, oil, food oil, flour prices have gone up and stayed there, whereas now they're not contributing to our inflation any longer. In the wake of the presidential elections in the US, do you have scenarios if the Fed moves to mild policy? What would we do, and what would be? We're doing it not only in the wake of the presidential elections, we're doing it on a daily basis. It's the US Federal Reserve System that sets the levels. So there are possible vectors, positions, and policies. We need to understand it. Irrespective of the presidential elections, we keep monitoring and tracking it attentively. They're built into our policy. In taking our policy decisions, there is a big share of the Fed consideration. The rate set by the Fed is essentially linked to our rate. So making predictions about them would be difficult, of course. About the agricultural produce market signals, do you consider them essential? They're not significant at this point. Thank you.